Of late, there's a lot of buzz around the index funds in India. A lot of people are saying that index funds are the future of mutual fund investment, which is the passive style of mutual fund. So what is a passive style of mutual fund and how is it different from the active mutual fund? Hello friends, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. As an investor, when you invest in a mutual fund, you would find various types of mutual funds. For example, on the basis of fund selection, you have equity mutual fund, debt mutual fund, hybrid mutual fund, etc. So equity mutual fund invest in your stocks, debt mutual fund invest in your bonds, and hybrid mutual fund invest in a mix of both stocks and bonds. Now within equity mutual fund, you have various subcategories like your large cap, mid cap, small cap, flexi cap, multi cap, etc. But there is another categorization of mutual fund. It is based on the mutual fund investment style. Within that, you have two types of mutual fund, active mutual fund and passive mutual funds. So if you want to invest in an equity based mutual fund, you can choose between the active versus passive style of mutual fund. So in this video, we will try to understand what is an active versus passive mutual fund, the difference between active versus passive fund, and we'll also try to identify which style of investment is better, active or passive. Alright, let's get started. Active mutual funds are the funds that are actively managed by the fund house where the fund manager actively buys and sells the stocks in the portfolio of the mutual fund to generate high returns. The ultimate goal of each mutual fund is to beat the benchmark. What is a benchmark? So benchmark is the criteria you can use to compare the performance of a mutual fund. For example, let's say in the last 1 year, your mutual fund has given around 12% return. Now what can you infer out of it? Did it perform well or not? For that, you need to compare it with the benchmark. So if the benchmark has given 15% return in last 1 year, then your mutual fund has not done well. But let's say your mutual fund has given 5% return in a year, but the benchmark has given 3% return. In that case, your mutual fund has done well as it was able to beat the benchmark. So benchmark is very important. Now what are some of the examples of benchmark? Sensex is a benchmark for those mutual funds that invest in the top 30 companies of India. Nifty 50 is a benchmark for those mutual funds that invest in top 50 companies in India. Likewise, you have Nifty 100 as benchmark, Nifty 500 as benchmark, and so on. When you invest in mutual fund, your mutual fund house charge a fee somewhere in the range of around 0.5% to 1.5% to actively invest your money in the stock market, where the fund manager would keep buying and selling the stock frequently. Here we are talking about the direct option. Regular option would have additional commission of the agent. In that case, the expense ratio would be between 1.5% to 2.5%. The ultimate goal of each active mutual fund is to beat the benchmark. But what if the active mutual fund is not able to beat the benchmark? In that case, isn't it better to invest directly in the benchmark? Why pay a high expense ratio? That's where your passive mutual fund comes into picture. Passive mutual funds exactly replicate the benchmark. For example, if there is a passive mutual fund that replicates Nifty, then passive mutual fund would hold each stock of Nifty in the exact same proportion. So if Reliance has got a weightage of 12% in Nifty, then out of rupees 100, 12% of your money would be invested in Reliance. If HDFC Bank has 7% weightage, then 7% of the money would be invested in HDFC Bank, and likewise. I hope now you understand what is an active mutual fund and what is a passive mutual fund. Some examples of index fund include HDFC Nifty 50 Index Fund, SBI Nifty 50 Index Fund, UTI Nifty 50 Index Fund, etc. Likewise, there are various index funds that replicate Sensex, Nifty Next 50 and other indices. Recently, there is a new mutual fund that is being launched by Navi Mutual Fund in Nifty 50 category with the name Navi Nifty 50 Index Fund starting 3rd July. We'll quickly look at the details about this fund in the later half of the video. Now that you understand what is active mutual fund and passive mutual fund, let's understand the difference between active versus passive mutual fund. So the first difference is that in an active mutual fund, the fund manager actively buys and sells the stock from the portfolio, whereas in a passive mutual fund, the fund manager simply replicates the stocks in the same exact proportion based on the benchmark it replicates. Second difference is that in an active mutual fund, the goal of the fund manager is to beat the benchmark in terms of returns, whereas in passive mutual fund, the goal of fund manager is to fetch same return as of benchmark. And the third difference is that in an active mutual fund, the fund charges an expense ratio somewhere in the range of 0.5% to 1.5% for direct plan, whereas index fund expense ratio is between 0.05% to 0.3%. When it comes to active versus passive mutual fund, there is a lot of debate between whether active funds are better or passive funds. Both styles have their own set of supporters. The supporter of active mutual fund says that in a country like India, where there is a lot of inefficiencies, that is, there are a lot of companies that can potentially generate higher return, it makes sense to invest in an active mutual fund where the fund manager would actively buy and sell the right stock to beat the benchmark. However, the supporter of passive mutual fund says that in the long term, your active funds can't beat the benchmark by actively buying and selling that stock, and the fund houses are charging high fees to mint money. Hence, it is better to simply replicate the index like your Sensex or Nifty for the long-term investment. On top of this, the passive fund charge a very low expense ratio, as low as somewhere in between 0.1% to 0.2%, which means the profits are passed on to the investor by deducting just 0.1% to 0.2% fee as compared to active funds that charges expense ratio in the range of 0.5% to 1.5%. In fact, the new index fund of Navi Nifty 50 index fund has an expense ratio of just 0.06%. That's almost negligible fee. If you look at the developed market like the US, most of the people invest via the index fund, as the active funds are not able to beat the benchmark and the index funds are available at a very low cost. But in a developing country like India, it is still debatable if the index fund, that is the passive fund, can beat the active funds or not. However, if you compare the historical performance, around half of the large cap active funds are not able to beat the benchmark. It means there are high chances that you might end up investing in active mutual fund with high expense ratio which are not even able to beat the benchmark in the long term. For example, in the last 5 years, Nifty 100 TRI benchmark has given around 15.68% return, whereas among the top 10 large cap active fund, only 3 funds are able to beat the benchmark to give more than 15.68% return in last 5 years on an average. So clearly, very few active funds are able to beat the benchmark. Hence, it is better to invest in index fund, especially in the large cap category. To shortlist an index fund, you need to look at two major parameters: expense ratio and tracking error. At the end of the day, since an index fund simply replicates the benchmark or index, the return should also be same as that of index. However, the index fund doesn't give the exact return as that of index. It is mainly due to two reasons. First reason is because the index fund charges a small fee, that is expense ratio, and that gets deducted from the return. Second reason is due to tracking error. Now, what is tracking error? Tracking error is basically the error in replicating the index. For example, when the fund manager replicates the index, the fund manager also needs to reallocate the fund in case of addition or removal of a stock from the index. For example, if Divis Lab enters into Nifty 50 and Z exits from Nifty 50, the fund manager would have to invest in Divis Lab and exit from Z. Likewise, the fund manager needs to keep some cash handy in case of redemption from investors. Also, fund managers need to keep investing the money in the same proportion based on the amount received from the investor. Hence, due to all these factors, there is a tracking error, and the return from index fund are slightly lower than the index. So, if you want to invest in an index fund, you need to ensure that the index fund has a lower expense ratio and lower tracking error. In case you are looking for an index fund with a very low expense ratio, there is a new fund from Navi Mutual Fund that is launched on 3rd July and will be available for NFO till 12th July. In case you are not aware, Navi is the new venture of Sachin Bansal. I'm sure you all know who Sachin Bansal is. He was the co-founder of Flipkart. After Flipkart, Sachin Bansal has now entered into the fintech space with services like your personal loan, home loan, vehicle loan, insurance, etc. Now Navi has also entered into the mutual fund space with a passive mutual fund in Nifty 50 category. Its expense ratio is 0.06%, which is among the lowest in the country. You can explore the fund details in the link given in the description. But before you invest your money in mutual fund, remember that mutual fund investments are subject to market risk. So please read all the scheme related documents carefully before investing your money. I hope you will find this analysis useful. I will see you with another video. Till then, take care.